3.9%. That's the number that just destroyed 40 years of global financial stability. Right now, the Japanese 30-year government bond yield is flashing red at the highest level since these bonds were created. And if you hold U.S. stocks, bonds, or any retirement account, you are already bleeding money. You just don't know it yet. This isn't a warning about what might happen. This is confirmation that the detonation has already occurred. Let me show you exactly where this bomb is exploding. The bond trading floor at the Bank of Japan headquarters in Tokyo. Screens displaying 3.9% yields. Traders watching in silence as decades of monetary orthodoxy collapse in real time. Across the city, risk managers at hedge funds are calculating exposure on $20 trillion in leveraged bets built on zero Japanese rates. That assumption just died. Liquidation has begun. In New York at the Federal Reserve, currency intervention operations are underway. The United States government is buying yen to prevent collapse. When the world's reserve currency issuer must rescue a trading partner's money, the global financial architecture is fracturing. At Treasury, Secretary Scott Bessent is asking Japan to say calming things. Words, not actions. Desperation disguised as diplomacy. Here's the mathematical reality. Japan's debt-to-GDP ratio is 250%. For 30 years, they paid virtually zero interest. Imagine a credit card with no interest for 3 decades, maxed out, and suddenly the bank demands payment. That's Japan. And it matters to you because Japan owns $1.2 trillion in U.S. Treasury debt. When Japanese investors sell those treasuries to cover losses at home, U.S. interest rates spike, stock markets crash, and the correlation breakdown begins. Bonds no longer hedge stocks. Both fall together. The precedent is documented. The structural chain creating Japan's crisis started 40 years ago with a single policy decision. Understanding that sequence is the only way to position for what comes next. September 22nd, 1985, 9 a.m. Eastern Time. The finance ministers and central bank governors of 5 nations gathered at the Plaza Hotel in New York City facing Central Park. The United States, Japan, West Germany, France, and the United Kingdom. The meeting was secret until the announcement. The goal was coordinated intervention in currency markets to depreciate the U.S. dollar, which had appreciated 50% against major currencies from 1980 to 1985, pricing American manufacturers out of global markets and creating a trade deficit of $112 billion in 1984. The Reagan administration faced an impossible dilemma. The strong dollar resulted from Federal Reserve Chairman Paul Volcker's tight monetary policy designed to crush inflation. Interest rates had reached 20% in 1980 and 1981, attracting capital inflows and driving the dollar higher. But that appreciated currency was destroying American industry piece by piece. Steel plants closing in Pennsylvania and Ohio. Auto manufacturers in Detroit losing market share to Japanese imports. Farmers unable to export grain because products were priced out of international markets. Congress was preparing tariff legislation. The Plaza Accord announced that further orderly appreciation of non-dollar currencies is desirable. The language was diplomatic. The intent was clear. The United States wanted the yen and Deutsche Mark to rise. Japan agreed to accept yen appreciation up to 200 yen per dollar. Finance Minister Takeshita calculated that accepting currency appreciation would reduce pressure for sector-specific trade restrictions. The semiconductor dispute was escalating. The goal was 10 to 12% appreciation, controlled, manageable. The yen stood at 240 per dollar on Friday before the announcement. 10% appreciation meant 216 yen per dollar. This level was reached by September 30th, 8 days later. But currency markets don't stop at government targets when momentum builds. By the end of 1985, the yen approached 200 per dollar. By May 1986, 160 per dollar, a 33% appreciation in 8 months. By 1988, the yen traded at 120 per dollar, a 100% appreciation in 3 years. The currency doubled in value. Japanese exports became uncompetitive overnight. Toyota, which had reached cumulative production of 50 million vehicles in January 1986, reported operating income down 34.9% for the fiscal year ending June 1986. The impact of yen appreciation was 290 billion yen in reduced profits. The strongest manufacturing company in Japan was being destroyed by currency policy. The government's response was to flood the economy with liquidity. The Bank of Japan cut the official interest rate from 5% in 1986 to 2.5% in 1987, attempting to offset the deflationary impact through massive monetary expansion. Now watch what happens when you combine a rapidly appreciating currency with extremely low interest rates. The combination created the conditions for the largest asset bubble in modern history. Real estate prices in Tokyo reached levels where the grounds of the Imperial Palace were valued higher than all of California. Golf club memberships sold for over $1 million each. The Nikkei stock index, which hovered around 10,000 in 1985, rose to 38,915 at the end of 1989, a nearly 400% increase in 4 years. The private sector capital to national income ratio spiked from under 500% in 1985 to 700% in 1990. Economist Thomas Piketty identified it as the largest asset bubble in any advanced economy between 1970 and 2010. But bubbles built on monetary stimulus rather than productivity growth are mathematically unsustainable. The Bank of Japan began tightening policy in 1989, raising rates to contain emerging inflation. Asset prices peaked in 1990 and began collapsing. The Nikkei fell from 38,915 to 7,862, an 80% decline that wiped out trillions in paper wealth. Real estate values fell 70% and did not recover for decades. Banks holding loans collateralized by inflated assets faced insolvency. Corporate balance sheets showed massive losses. The three excesses emerged: excess fixed assets, excess employment, excess debt. Japan entered what became known as the lost decades. GDP growth averaged 1.14% annually from 1991 to 2003. The stock market did not return to its 1990 peak until 2023, 33 years later. Real estate prices in Tokyo have still not recovered. The lesson is clear. When governments use currency policy and monetary stimulus to offset structural problems, the result is asset bubbles, debt accumulation, and eventual collapse. The time between policy error and crisis can span decades, creating the illusion of stability. But mathematics always reassert. Apply this blueprint to Japan today. The Plaza Accord forced appreciation and stimulus, creating bubbles that burst, leading to 30 years of zero rates and debt accumulation. That debt reached 250% of GDP. The attempt to exit zero rates is triggering the second phase, the debt crisis. The bomb just detonated. The detonation has 5 stages, each feeding the next like dominoes made of dynamite. Most investors don't even smell the smoke yet. First mechanism, the carry trade unwind. For 30 years, Japanese interest rates at 0% created the closest thing to free money in modern finance. Borrow yen at zero cost, convert to dollars, invest in U.S. treasuries yielding 4 to 5%, collect the spread, hedge the currency risk for a small fee, and generate consistent returns with minimal apparent risk. This was the carry trade, and hedge funds leveraged it massively. Current estimates suggest $20 trillion in positions, built using 20 times leverage because when money is free and returns seem guaranteed, and the trade has worked for 3 decades straight, why not maximize exposure? $20 trillion. That's more than the GDP of China. That's the size of the bomb. But Japanese bond yields are no longer zero. The 30-year yield reached 3.9%. The 10-year yield is above 1%. The spread over U.S. treasuries has collapsed to nearly nothing. At 3.7% Japanese yields versus 4.5% U.S. yields, the carry trade generates only 0.8% before hedging costs. After accounting for currency risk management, the trade is break-even or negative. And no rational investor continues a break-even leveraged position when that position requires rolling over financing and maintaining margin requirements. So the unwind begins. Sell U.S. treasuries, buy back yen, close positions, de-risk. And the scale is enormous. $1.2 trillion in Japanese held U.S. debt, plus trillions more in hedge fund positions, all being liquidated simultaneously, flooding the market with sellers and no buyers. The preview occurred in August 2024. Japanese markets crashed. The Nikkei fell sharply in a single day. Margin calls hit leveraged funds across Tokyo and New York and London. Forced selling spread globally like a contagion. Bitcoin fell 23% in 72 hours. The Nasdaq dropped 10%. The S&P 500 declined 8%. Over $1 trillion in market capitalization evaporated in 3 days. And that was just a warning shot. That was a temporary liquidity crisis that central banks managed to contain through emergency interventions. The full unwind will be exponentially larger because the structural problem has worsened since August. Japanese yields have risen further, debt levels have increased, political pressure for fiscal spending has intensified, the fuse is shorter now, and the explosive charge is bigger, and it gets worse. The second mechanism is the bond yield explosion. Japan's Prime Minister Sanae Takaichi is pushing for massive fiscal spending, despite the country already drowning in debt at 250% of GDP. She is calling an election to secure a mandate for increased government expenditures, promising voters that she can manage it without issuing more debt, that there's some magical way to spend more while borrowing less. But bond markets do not believe political promises. They price mathematical reality. And the reality is that a government with the worst debt burden on earth cannot increase spending without borrowing more. The laws of arithmetic do not bend to political will. Bond yields are the market's verdict on that reality. The 30-year yield hitting all-time highs is investors collectively saying, no, we will not finance this at current rates. If you want our money, you must pay higher interest that compensates for the risk of default or monetary debasement. And higher interest rates on 250% debt to GDP is not just concerning, it is catastrophic. Follow the mathematics. A 1% increase in average interest rates on that debt load equals 2.5% of GDP in additional interest payments annually. Japan's entire annual budget consumed by debt service, leaving nothing for infrastructure, defense, healthcare, pensions, education, any of the things government actually does. The choice becomes default, money printing, or austerity so severe it triggers social collapse. None of these options are politically viable. All of them are becoming mathematically inevitable. The explosion in yields is not temporary volatility that will mean revert. It is permanent repricing. Markets have recognized that Japanese debt is unsustainable at historically low rates, and the feedback loop has started. Higher yields increase debt service costs. Higher debt service worsens the deficit. Larger deficits require more borrowing. More borrowing pushes yields even higher. A spiral that ends in either fiscal collapse or monetary financing. And monetary financing means inflation, which destroys yen purchasing power, which forces even higher nominal yields to compensate lenders for currency depreciation. The mathematics are inescapable. Third mechanism, the Treasury dump. And this is where the crisis crosses the Pacific and lands on American shores. Japan holds $1.2 trillion in U.S. Treasury bonds, the largest foreign holder. Those holdings were accumulated over decades through the carry trade and reserve management, viewed as safe assets, the bedrock of portfolio stability. But those holdings are now liabilities, not assets. As Japanese yields rise and the carry trade unwinds, Japanese institutions must sell U.S. treasuries to repatriate capital, cover losses in domestic markets, and meet obligations to depositors and policyholders. This is not a choice. This is survival. $1.2 trillion sounds large, but the leveraged exposure is far worse. Hedge funds and institutional investors who borrowed yen to buy treasuries have multiples of that amount in positions. When these leveraged players receive margin calls, they do not sell gradually in orderly fashion. They dump everything at market prices immediately to avoid insolvency. Liquidity disappears. Bid-ask spreads widen from pennies to dollars. Treasury prices fall. Yields spike. And the selling accelerates in a cascade. The August 2024 episode showed exactly this sequence. Forced selling in one asset class spreads to all risk assets as traders raise cash wherever possible to meet margin requirements. But that's not the real threat. Europe adds another layer of catastrophic risk. European investors hold approximately $8 trillion in U.S. Treasury bonds, double the combined holdings of China and Japan. If Europe needs to fund increased defense spending, as the United States is demanding, as geopolitical tensions rise and NATO commitments escalate, European governments may sell treasuries to raise capital, adding massive sell pressure to an already fragile market. The United States government faces the nightmare scenario: simultaneous selling from Japan due to financial crisis and from Europe due to fiscal necessity, while domestic demand for treasuries declines as the Federal Reserve reduces its balance sheet. The buyer of last resort is shrinking just as supply is exploding. Supply and demand curves crossing in the worst possible way. Fourth mechanism, the correlation breakdown, and this is where traditional portfolio theory collapses completely. In normal markets, stocks and bonds move inversely. When stocks fall, investors flee to the perceived safety of government bonds, driving bond prices up and yields down. This negative correlation makes the 60-40 portfolio, 60% stocks, 40% bonds, a functional diversification strategy. The bonds cushion stock declines. The portfolio maintains value through volatility. This correlation has held for decades and formed the basis of institutional portfolio construction, pension fund management, retirement planning, everything. But when government creditworthiness is questioned, when sovereign debt itself becomes the risk rather than the hedge, correlations break. Both stocks and bonds fall simultaneously because they are both claims on the same potentially insolvent entity. They move together because they share the same fundamental risk: sovereign default or monetary debasement. The diversification that protected portfolios for 40 years vanishes overnight. Ken Griffin of Citadel, one of the most successful hedge fund managers in history, warned explicitly about this. When bonds and stocks move together in prices, bonds lose a substantial part of what makes them so special in constructing a portfolio. Translation? Your hedge no longer works. Diversification becomes illusion. A portfolio that held 60% stocks and 40% bonds, expecting the bonds to cushion stock declines, discovers both sides falling at the same time. The correlation breakdown means 100% risk exposure regardless of allocation. And here's what makes this truly terrifying. Bank of America data shows that money managers controlling $175 billion in U.S. markets have zero downside protection right now. Half of them are fully long, fully exposed, completely unprepared, because everyone assumed stocks always recover over time. Everyone assumed bonds always provide safety in a crisis. Everyone assumed the system always functions because it has for their entire careers. These assumptions are breaking in real time. Fifth mechanism, the currency intervention trap. And this reveals just how desperate the situation has become. The United States Federal Reserve is intervening in currency markets to support the yen, not the dollar, the yen. The central bank of the world's reserve currency is propping up a foreign currency to prevent systemic collapse. This is extraordinary. This signals that the problem has escalated beyond normal market mechanisms, beyond what monetary policy alone can fix. Intervention works temporarily. It can smooth volatility. It can buy time, but it cannot solve structural imbalances. Japan's debt is still 250% of GDP. Fiscal policy is still expansionary. Structural reforms are still absent. Intervention treats symptoms, not causes. And intervention has consequences that create new problems. If the Fed is buying yen, it is selling dollars, increasing dollar supply in foreign exchange markets. That weakens the dollar. A weaker dollar might help U.S. exports by making American goods cheaper for foreign buyers. But it also imports inflation, raises costs for American consumers buying foreign goods, and reduces the purchasing power of dollar holders globally. If this becomes the new baseline, as Treasury Secretary Bessent has suggested publicly, there will be much more dollar weakness ahead. And dollar weakness accelerates the long-term shift away from dollar reserves, encouraging central banks worldwide to diversify into yuan, euros, gold, anything but dollars. Now the timeline in 3 phases. Phase 1, 2026, the cascade. Carry trade unwind accelerates. Japanese institutions sell hundreds of billions in treasuries. Forced selling spreads from bonds to stocks to crypto to commodities. Liquidity drains from all markets. The VIX spikes above 50. Circuit breakers trip repeatedly. The S&P 500 falls 20 to 30%. Technology stocks fall 40%. Bitcoin collapses 50% in 72 hours. Pension funds watch portfolios decline 30%. A portfolio down 30% must gain 43% to break even. Not feasible in a broken market. Phase 2, 2027 to 2028, the restructuring. Japan faces 3 choices: default, austerity, or monetary financing. Every government chooses monetary financing. The Bank of Japan begins unlimited bond buying, printing yen to fund deficits. Japanese inflation hits 10, 15, 20% annually. The yen depreciates to 300, 400, possibly 500 per dollar. Everything gained through forced depreciation, lost through monetary destruction. Globally, if Japan can print without immediate collapse, others follow. Italy, France, the UK. Currency wars begin, competitive devaluations, trade restrictions, the monetary system fragments. Phase 3, 2029 to 2030, the new equilibrium. Japan stabilizes at permanently lower living standards. Debt financed by the Bank of Japan rather than markets. Inflation chronic at 5 to 10% annually. The yen trades at 400 to 500 per dollar. Exporters benefit, but consumers suffer catastrophically from import costs. Globally, investors learn government bonds are not risk-free. Gold rises to $5,000 per ounce. Silver multiplies. Real assets outperform financial assets. The shift from paper to tangible wealth is permanent. Who wins and who loses? The losers are Japanese citizens holding yen savings. People like Takeshi, a 68-year-old retiree who worked 40 years at Toyota and saved 30 million yen. With 15% inflation and yen depreciation, his savings lose 20% purchasing power annually. 4 decades of discipline evaporated. The losers are pension funds expecting positive returns from stocks and bonds. Both fall simultaneously. Retirees face benefit cuts of 30 to 50%. The losers are holders of leveraged carry trades. Margin calls liquidate positions at catastrophic prices. The losers are modern monetary theory believers who assumed unlimited printing without consequences. The winners are holders of physical gold and silver purchased before the crisis. Gold at $5,000 means 100% returns. The winners are those positioned in uncorrelated assets, commodities, energy, farmland. The winners are short sellers who understood the carry trade mechanism. The winners are those who studied the Plaza Accord and recognized government intervention creates delayed catastrophic consequences. Let me destroy the 3 counter-arguments you're thinking. Counter-argument 1, Japan has run massive debt for 30 years without crisis. They'll continue indefinitely. Wrong. The structural condition changed. For 30 years, rates were 0. New debt cost nothing. But rates are no longer 0. At 250% debt to GDP, even 2% average rates mean 5% of GDP to interest. The old equilibrium is broken permanently. Counter-argument 2, The United States won't allow Japan to collapse. Intervention will contain the crisis. Partially true, but ultimately futile. Intervention treats symptoms, not causes. Japan's debt is still 250%. Fiscal policy still expansionary. Intervention delays, but cannot prevent mathematical inevitability. Markets stop accepting promises and demand resolution. That point is now. Counterargument 3. Traditional diversification protects investors. Wrong. This is where traditional diversification fails. Stocks and bonds fall together. The 60-40 portfolio loses on both sides. Cash loses to inflation. The only protection is assets outside the system. Physical gold, silver, commodities, real estate in stable jurisdictions. Traditional portfolio theory assumes stable correlations. This assumption is breaking. Here is what you do immediately. First, reduce exposure to assets dependent on low rates. Technology stocks with negative cash flow. Speculative crypto. Real estate investment trusts. Position in quality companies with pricing power and strong balance sheets. Microsoft, Apple, Google, Meta. Second, allocate to defensive sectors. Energy companies like Exxon and Chevron. Consumer staples like Coca-Cola and Walmart. People need food and energy regardless of economic conditions. Third, acquire physical gold and silver now, not ETFs. Actual metal held personally or in allocated storage. 10 to 20% of portfolio. Physical metals are insurance. Fourth, avoid leverage entirely. Margin debt, options, futures. Leverage amplifies gains, but guarantees destruction in falling markets. The carry trade proved this. 30 years of success wiped out in days. Fifth, watch the 10-year Treasury yield. If it breaks decisively above 4.5%, the repricing cascade accelerates. At 5%, S&P 500 fair value falls 30%. The bond market leads. The stock market follows. Sixth, maintain 20% cash reserves despite inflation. The inflation loss is predictable, 3 to 4% annually. The volatility loss on forced selling is catastrophic, 30 to 40% in weeks. Cash provides survival optionality. Seventh, diversify currency exposure. If the yen collapses, contagion spreads. Hold dollars, euros, Swiss francs, physical gold. Government promises break when mathematics demand it. Let me show you why this cannot be stopped. The Plaza Accord cycle proves intervention creates consequences, manifesting over decades. Forced yen appreciation led to monetary stimulus, which created bubbles, which burst requiring zero rates for 30 years, which enabled debt accumulation to 250%, which is now unwinding. Every intervention created necessity for the next. Each made the ultimate crisis larger. You cannot solve problems created by intervention with more intervention. The carry trade, unwind, is mechanical. When positions are leveraged 20 times and spreads disappear, closing is not optional. It is survival. No amount of reassuring words changes mathematics. 20 trillion in positions takes months or years to liquidate. Each day brings new selling. The correlation breakdown is structural. When debt reaches 250% and yields rise, stocks and bonds are claims on the same potentially insolvent entity. They share the same risk. Diversification between them is concentrated exposure disguised by different labels. Only assets outside the system provide protection. You have been warned. The structural chain is clear. The Plaza Accord of September 22nd, 1985, forced currency appreciation, which required stimulus, which created bubbles, which burst requiring zero rates for 30 years, which enabled debt accumulation to 250%. Now that debt is unwinding. Japanese 30-year yields at all-time highs. Carry trades liquidating. U.S. Treasury selling accelerating. Correlation breakdown beginning. The Fed intervening desperately. But containment is impossible because mathematics are inevitable. Japan's debt bomb is detonated. The blast radius includes every portfolio holding U.S. stocks or bonds, every pension depending on 7% returns, every hedge fund leveraged to carry trades, every investor assuming bonds hedge stocks. The assumptions that worked for 30 years are breaking in 30 weeks. Those unprepared will discover knowledge of historical patterns. Is not academic curiosity. It is financial survival. If this analysis opened your eyes to what's really unfolding, hit that like button because this information needs to reach more people before the cascade accelerates beyond positioning. Subscribe and turn on notifications because when phase 2 begins, when Japanese monetization starts, I'll be breaking down the mechanics in real time, showing exactly where to position. And if you want to understand how the Federal Reserve is positioning for this crisis, watch the video I'm linking next. The countdown has started, the fuse is lit. Don't be the last one to realize the building is on fire. You have been warned.